This is Justin Pulitzer. This is my weekend review video for Sunday, September 27th, 2015. Just want to apologize ahead of time. I am a little bit under the weather, so if my voice sounds funny or what have you, please be understanding. I'm doing my best. So let's jump right in. The Fed, Yellen was speaking this week. She had some comments. She actually got a little bit sick at her presser and was sort of unable to really kind of finish in the end. But she basically said that they're leaving the door open. They still think they're raising rates for 2015. I think I've been pretty clear on my stance that I don't believe the Fed is raising interest rates in 2015. And if they do happen to make such a foolish mistake, I would construe it as a policy error. You don't really want to raise interest rates unless you're looking to tamp down inflation or unless you have an overheated economy. Anyone who's been watching my videos for the last few months, last year, knows that we have anything but. We're in an environment of crashing commodities, stall speed GDP. Actually, this week it kind of went under the radar. I know that there was a lot of hoopla made about the Q2 GDP revisions being higher, but the Atlanta Fed, which is where Hawk-in-Chief Lockhart is based out of, lowered their GDP forecast for the third quarter. So there's still some weakness. We'll see how that plays out. I've been talking about that coming from China. So before we do anything these days in the market, we go through my gauge that I see being key, and that would be the VIX, the dollar, the bonds, the oil, and China. And now you can also throw in a bit of a wild card this week with the debt ceiling showdown and Speaker Boehner stepping down. So that adds another little bit of a wild card to the week. My thesis this week is that it's the end of the quarter. There's been a lot of underperformance in the markets, and that we could potentially see a rally. It's not really a done deal because the market has been so weak, and the technicals, as I'm going to show that we're sort of looking for another leg lower in terms of a bearish tape. But funds may need to kind of window dress and pad their returns. We know they have not been having the best of quarters, and that could lead to a bit of a rally this week. So let's start off. So we're in VIX. You know that I believe that anything above this 20 level, so I always just say 25, puts crash risk on the table. You know, if you start getting above the 31, that's really confirming. And really anything above this 1785 to 1757 is the upper end of volatility. You can see anything up there has been unsustainable with brief flurries. Then we've been mostly spending time below. However, we have done something recently that we haven't done in quite some time, and that is make a higher high, a significantly higher high on a volatility spike. You can see we had the spike to 31 here. We receded. The tides of fear came in. We rallied back up to the 25, and then there was a bit of a choppy period before really kind of settling back in. So I view this time period very similarly as this time period, that we will likely need to see at least a lower high before the market can sustainably rally. So you can see here that we've been pulling back, making still lower highs, lower lows. However, this spike low here held the tail line of support of this area. So what was resistance could become support, and it's possible that we do see some type of a rally up in terms of volatility to try to make a lower high, and maybe even really get going if we're truly in a bear market. So you really have to keep your eye on the IV. You can see here that we have been sort of muddling here, sort of looking like we might be forming a base to have that throwback higher to see about the spike in volatility. The dollar, I've been using the UUP. A lot of people don't know about the the VIX futures. The dollar futures, which are DX/DX, but you can see in the UUP, we are consolidating and sort of just in a bit of a long, protracted bull flag, stalling under the 50, holding the 200 here, I will show you on the DIX, on the DX, that, oops, not DC, DX, you can see that let me get us into a more close time frame. You can see we've been making lower lows here, but now we are starting to make higher lows and higher highs, coming back in and challenging this area. It is good here, though. This is a reversal bar. We did close rather weak below the 50-day moving average. This could be construed as a look above and fail. You can see the last time we sort of had an inverted hammer like this, we fell out of bed a bit. That would be good. If you start seeing a move down in the dollar, that probably means the commodities rally, copper and oil, and a receding dollar is good for the equity market. So you got to keep an eye on the dollar, really, really key. A lot of you probably don't use the ZBs, but let's use TLT. I like that instrument. You can see we had a island reversal up here, and then a gap below and hold. This is a little bit of a dangerous pattern because, as you know, the 123.15 is the 2009 crash top, and anything above there kind of puts the highs into play, or at least this gap fill to the 26s. Anything below there to me is a little bit iffy for a move mid-range, somewhere into this area here, the 119s, the 118s. I do believe 117 is a very key pivot, but it is sort of just in this consolidation range. You don't really even need to see the bonds rally. You just don't want to see them fall out of bed. If interest rates spike, and I know the media doesn't understand this, stocks are valued on a discounted cash flow basis, DCF, and if you have a denominator that is increasing, the end product and of course a numerator staying stagnant, you have an end product becoming worth less. When you have that, you also deal with multiple contraction. Higher interest rates mean people are willing to pay less for stocks. Lower interest rates, people are willing to put a higher multiple on those earnings. Pretty simple there. Let's do oil. You could use USO if you want. I've been talking CL. It is good that we are closed above the 50-day moving average here. That has been a really big problem for a while. You can see, look, spikes into the 50 have been met with selling. Rallies above have been tough to sustain. I do believe that this pattern is trying to bottom. I know that's not necessarily what the media consensus says, but it is also conceivable that we do make another run for the lows and retest the 37, maybe even the 33s. But I do believe that the oil here is trying to form some type of a low. It might be messy. It might take a while. I do believe at some point we're going to retest higher into the 60s. My end target is really 75. I don't want to. That's about a 74 is about a 50% Fibonacci retracement of the move. Actually, you know what? Let's use I did some pre-programming here. Yeah, you can see this is 90s are really where the big breakdown was. Then the 74s really was when this thing completely collapsed. So that's about a 50% Fibonacci retracement. I do think that will happen eventually. I don't know what the order of operations is going to be, if this has to go lower first or if we have to go higher. I will say, though, that stocks like Exxon have been having a similar pattern, and on days with a lot of relative market weakness, it's sort of been trying to hold itself together. So oil not going down, going up a little bit is good. We need to see that. The same thing with the FXI. It doesn't even really need to rally. It just doesn't need to keep crashing. When you have a market like China crashing, it's very bad. We are hovering, believe it or not, around a really key trend line here. We have looked below it a couple of times, failed, and we're just hovering around there. I do believe somewhere in these 32s to potentially 28s could be the really kind of the end of the line here in terms of the decline. I don't really want to go too much back in the charts, but just take my word for it. This is a key congestion area. So I do believe it's possible we do come down, maybe even make lower lows. But somewhere in this area, I do believe we should find a little bit of stability. It would be really surprising to see a bull market like this completely collapse without some type of a leg to at least a lower high. I'm keeping my eye out for that. I know that's not kind of consensus, but I do believe it is possible and actually very likely. So let's talk SPY for a little bit. The SPY is in a bit of a consolidation here. It's a bear flag, if you will. Let me get us into... There's a new design in TOS, so I'm just kind of getting a little bit used to it. Sorry if this chart's a little messy. I have a lot of Fibonacci levels on here, as you can see. Some of them more relevant than others. So you can see that this came up here roughly to the 61.8 from the top here, which I had said was roughly the 1.618 Fibonacci extension from the 2007 peak highs to the March 2009 lows. If you added on a Fibonacci extension past that 2007 peak, if you guys want, I've shown that in previous videos, you can see that that came up to about here. I had made a call that I had said I thought this time could be different. You know, we've been rallying, making these, you know, slightly higher highs and then coming back. The market was feeling tired, and I said that this time could be different, and we know that it was. So we are in this sort of bear flag pattern. I would say I had been saying that I thought the max this could rally was really to the 204s. We didn't even get that high. We got up to the just under 203s. There was also a previous old up channel here. We didn't get to the back of that. Believe it or not, we could still rally back up to this area and still be in the context of a bear flag. A lot of people are using this 199.84. You see I have it marked here as sort of the flagpole. Anything above there would be more bullish. As we can see, we looked above and it didn't hold and we came back down. I really just look at this as a range. I had said that I thought the 61.8 with the 90s would be a key area. 92s were a key area, and also 90s. We stopped just shy of that. You can see, though, here the close on Friday was 192.85, and our close the day before was 192.90. So we are really kind of just below that. There wasn't a lot. I mean, this is a pretty nasty reversal bar here, although there wasn't like a ton of technical damage done. I do still think it's possible we could come down and kiss these 87s and fill the gap, but we'll see. Like a gap down to here, I don't know if we're going to get something at that extreme, although you never know with these crazy markets. And I am filming this before the time would be relevant on Sunday for the futures to be open. But a gap down to this area to me would be a very interesting buy for a rally up higher. If you take a look at where we closed at these, let's just say this is, let's just say it's 193. This would really just be a move back down into the range. Or if you wanted to go back up, that would take you up into fill the gap in here. So that's the expected move here. I think given the end of the quarter, there is a lot of potential for outsized moves. So I wouldn't put too much stake on that level of complacency, or should say the chop holding in SPY. It is possible, of course, but given the size of the moves we've been having and the fact that I do think that there could be a spike in IV, it particularly if there's a down move, I think that the risk for down is big, because if we really take out this range, it could be the signal that this was sort of just leg one, and we are now going to have leg two that would break these lows and go significantly lower. I'm not ready to make that call just yet, although I do think it is more likely than not to take place at some point. But I am also cognizant with the fact, like I said, that we do have expiration. I mean, the quarter end, and we could just really rotate back up to the upper end of this range and retest it again. I know a lot of people are bearish. It's possible that that happens. One of the major problems we've had is a lot of relative weakness in IWM. I'm going to discuss why that is in a second when we talk about biotech. There was a bit of a I wouldn't say head and shoulders top, but if you look at the snap move, that would roughly take us down to these 111s. We're kind of just hovering around there. It wouldn't shock me really to see it rotate back down and retest these 109s, 108s, maybe even lower to these 103s as the next leg if there's a snap to kind of fill up the entire move. Let's see if I can show you that. Yeah, you can see down to here. So I do believe there's some reference lows down in here, you can see, and that's what held us here. It's possible we come down here. This is the edge of the volume distribution. So there really isn't that much that would prevent it. If this snaps, there'd be a ton of overhead supply that we would fill up to come down to there. Primary trend is still significantly lower, down in the 99s. So maybe if it takes its time to come down, it coincides with this gap fill here over at the 103s. It's also a reference low. So I do think the 103s are really key. It would be interesting if it took some time and it coincided with the trend, like if it didn't just go right away. Qs have also been penalized. Also, you can see here a bit of a snap of the trend of this bear flag wedge. The Qs had been showing a lot of relative strength. They still are showing decent strength because they're not below these lows. It's I have to adjust my Fibonacci. You can see it doesn't take into account this spike, although you can see this spike did hold the trend. Some of the problems I've been saying, I discussed this on a interview I did on the Tasty Trade, on Shadow Trader Uncovered, on Tasty Trade on Friday. I don't know if you guys caught it, but if you go back and you listen on their site, or if you just want to listen to it here, what I think happened is algorithms cache these levels, these spikes, and they want to revisit them. That also human beings who program these algorithms and just traders have seen where price can go. They know that there wasn't really support, at least until 84 in a cascading event. That is a lot of points away from where we are up here in the 104s. Although we did close here at 102, sorry. So that's a lot of points away. It wouldn't shock me if we roll over and retest those lows, or at least try to get to them, maybe even undercut them a little bit, but we'll see. The 99 to 100 area is going to be really key. You can see these lows here. I would say if that snaps, we are going to see some pretty ugly price action in the NASDAQ. If it holds, and it's very possible it does, then we could, see some type of a rally back up. Again, that would be an amazing gap down to buy for a right or right out type of trade. Give it, a small window of error. One of the reasons we've seen a lot of weakness is this chart here, the biotech chart, the IBB. This has been getting a lot of coverage in the media the last few days. I was warning about this for quite some time, saying that we have a textbook head and shoulders topping pattern. It does not get any prettier than this for trying to play a head and shoulders. You had the Snapperooski down to trend. Look where we stopped just shy of. A rally back up. This is known as a check back to the head and shoulders, and a massive failure lower. And I had measured the head and shoulders. That's just the measurement from the head to sort of the neckline. I projected it here, and you can see where roughly a lot of this price action has taken place has been at that neckline. One of the problems, again, is the spike. People saw it. The algorithm saw it. This is where the breakout took place between the 275s and this Fibonacci level here, the 61.8, which is the 281s. So I do believe that it is possible. I mean, this has been a big price break very quickly. It's possible we have some type of a bounce throwback, to recheck this breakdown here of the 332s, but I would really see that as an amazing opportunity to potentially get short. It could even push a little bit higher to fill the gap to the 340, but I do believe we are going to retest and see that area again to revisit this algo level low. What will I do there? I will reverse my bearish bias and think it's a buy the dip area for a right or right out trade. Very defined prior support, a very defined reference low. I think you can play this with put ratios. If we get the bounce, try maybe a put spread for a move to become still back lower, particularly if there's like some type of an end of quarter bounce that does something stupid like take you to the downtrend line. That would set up as an amazing right or right out type of a short situation. That is what I'm thinking. I'm thinking lower. That is going to lean on a lot of stocks. One of my favorite ones is the Gilead. It's not a really expensive stock. It's really right on trend here. You can see any moves below have not been sustainable. Even on the flash crash day low, we still closed well above. Most of the price action, the body of the bar, was above the trend line. I don't like that we have taken out these lows here, these reference lows, the 101s, the hundreds. I've discussed that on the stream being key. This could have just been pinning. We roughly pinned 100. So this is going to be very important. I like put ratios. Again, look at where we stopped. Very similar to the IBB. This 84, 88, 85-ish was the breakout level. Reference lows, and a trend line here. If there is some type of a snap, I think it could come down there. I like put ratios. Maybe if you want to be long some 95s, short some 90s, or even if you want to be short some 85s, or if you want to be long some 90s and short some 85s, I like that. I like any type of spread or ratio where you have a break even or a lower strike roughly around 85. I think that could be the potential. If there's a bounce, I would use it to honestly to sell. Yeah, you could see the 109s again. That was really that's been a key level for a while. Anything above there has been, was a little tough to sustain for a while. Once we got above there, we held, but now you can see that this area is a volume distribution. I believe that would set up for a short. Also, I do like the stock longer term, but again, it's an order of operations. Really key levels in here in Apple that we're struggling with. 50-day moving average was a brick wall for Apple. It closed on Friday a little bit below where we needed. This bar here to me has been a very critical bar. This was the flash crash sort of scenario. And I've been using this bar for a long time with Apple, meaning below 115 is vulnerable to 111s, which are vulnerable to 109s. Which are here, sorry. And then that's vulnerable to 103s. Anything above here, 115 puts the 119 into play. Anything above 119 really puts the old highs into play. If there is some type of a rally on the short, like a end of quarter rally between the 119s and the 121s will probably be the kind of the end of that rally. It would be a good area for right or right out short, or to put on some put ratios or even outright spreads for moves lower. If we do wind up rolling over, I've been saying that I thought the 95s and potentially even the 85s could be in play, which is the big 61.8, and we all know how Apple loves Fibonacci levels. And, possibly even a full round trip, but I don't know if that would happen without earnings to get back down to close the gap to roughly about the 75. That would be 100% retracement. Anywhere in here, I think, is an amazing opportunity to get long. I would do it via short out of the money puts. If we come down hard and fast there, the IV in Apple will be jacked. You can see the stochastics are kind of above the upper band. We're kind of jonesing for a rollover. I could see that happening potentially. I wouldn't say it could happen for sure this week, but if there is weakness in the market, until we get the earnings going, I'm just using those levels, the 115s, the 111s, the 109s, and the 103s. I have on some ratios. I think it's long the 107 and short the 2 times the 103. I don't know if that's going to get much action, but I'll keep putting on, those types of spreads. I like to get 5, if you can get IV jacked and you can get like $5 or $6, that is a really good ratio spread. That, getting 6 is a lot. Usually if you can get 5, it's good. So that is Apple. Amazon is showing a lot of relative strength. It kind of filled the gap here. It's kind of poking its head back up to a bit of a lower high, though. That is a little bit disturbing. Let's see. There we go. The issue I'm seeing with this is that we are making a bit of a lower high. I can get rid of this one now, I guess. But the 50-day moving average to me is really key here. You can see that moves below it really weren't sustainable. We tried to rally back up here, and it kind of found acceptance held. You have a 20 and 50-day moving average confluence. There was a hammer here. This is a bit of a reversal bar. I would like ratios in this type of a stock. I don't know what kind of juice it would have with like a 500, long 500 put, and short 2 times as many, as low as you can get here, or maybe even go lower, buy into this area and then sell puts against the trend line. I believe that would be a winning type of a trade. If there is some type of a snap of this, and we do clear this high, I do think the all-time highs could be into play. And Amazon usually does well in the fourth quarter. Google really just kind of consolidating. It ran ahead of the quarter. It gapped. It kind of went down. It went up again on the split up news, then filled the gap. And now it's just been sort of consolidating, working off some of the overbought conditions. The pattern is still actually fairly constructive for higher, or for you kind of want to be a buy the dips, sell the rips on Google type of a situation. But again, this is another one I like with ratios or, some type of plays against the lower trend line, particularly with earnings coming up. A lot of these stocks I'm sort of just sitting on my hands for because I'm waiting for their earnings to come up. I think there'll be better plays in them based on the earnings. It's sort of as my old buddy Montana, who a lot of you followed, also used to say, the second mouse gets the cheese. Take a look at Facebook. This is one I've been really bullish on for a very long time. I said I thought we would see 100. We got really close. I still think, well, believe it or not, we will see 100 or higher. But it has been showing some corrective type of action. Look where this spike came down to. The old top, also a point of a lot of great contention. So the problem for me is that this level is now also cached with the algorithms. Facebook is held up really, really well. We know that they suffer when there's a strong dollar. I'm a little bit cautious if it's up ahead of earnings. If there is some type of a corrective move ahead of earnings, then I would say it's probably a long. If it rallies again, I would be a little looking to take some profits. The 50-day moving average, really this 92.54, anything above there I would say is still kind of bullish with a little bit of, give down to the 191s, this area. But the pattern is still bullish. I would like to see some type of a pullback. However, this has been a really good performer. If there is a performance chase into the end of the quarter this next week, this could get the Momo, because there's not a lot of dead bodies under here. It's not a broken story and it's not a broken stock. It could still rally considerably. I'm bullish on Facebook either for a move higher here if you want to be long like a partial position, or to play put spreads for some type of a move back more into range. Either one of those I like, as long as you could get it on for credits. I don't like to pay up for trades. Netflix. This has been looking a little bit more bearish. You could see defined uptrend. It's a channel. It's been on the wrong side of the other side of the channel for a while, fell back into the channel, and is now sort of struggling at those highs. I just want to kind of bring it into more modern times. Again, this is very much like the IBB chart. Head and shoulders top, a snap-a-rooski of the neckline. We've had a check back, another check back. That is a little bit concerning if you're bearish because, look, the downtrend has been broken here significantly with this bar here, this big Maribozo type of bar. Maribozo is just a Japanese candlestick term, meaning you basically open on the dead low and close on the dead high. There is a tiny smidgen of a wick here, but it's for the most part you get the point. It's one of those big body power bars. The next day, Friday, we did take it out, the high of that bar out, but had a little bit of a pattern failure and some consolidation. This to me is starting to not look right for the breakdown. I'm, believe it or not, starting to believe that there could be some type of a rally to fill the gap, maybe to retest the 50-day moving average for a little bit of a bounce in Netflix. I've been playing this. I actually had been playing this mostly for a move lower with put ratios. I'd actually been outright short the stock on this day. I wound up covering it fairly decently in the 90, I think it was 93-ish. I wasn't fast enough. I guess this didn't last long. I had been short from like 105 and had closed it. Then I had talked about reshorting here. So anyway, let's just take it to where we are here. It is still on the kind of the right side of the trend line. I actually have a call spread on, just taking a shot for a move higher, just for some window dressing. Maybe Netflix gets a little bit of mo. If we happen to lose this reversal bar, though, these lows, you can see it was sort of an important area of contention, this 96s. I would say that the price action of this will be a cascade lower down to retest these 85s and maybe even the measured move of the head and shoulders down to the 78s. Longer term, and this would probably take earnings, the breakout here was roughly around $70. That would also be a major gap fill. Wouldn't shock me to see if that happened. I know people don't believe that these things can take place, but I assure you, I've seen it before. I've seen it in Priceline. I've seen it in many stocks. This can happen. This would be a screaming buy, probably for a risk reversal to sell puts and to buy calls or call spreads or some type of a long situation. But that could happen, and I'd rather you be prepared for it. So if you are playing for upside, define risk only. Downside, I do think that there is some room to the downside. Tesla, just kind of consolidating, really needs to clear these 265s that had been an old high in the Wayback Machine back here. I do think it's possible that we could retest the old all-time high. This is a bit of a bearish bar here. It is possible if you lose these lows here in the 55s that we might want to retest that Elon Musk buy point at the 42s, but I do believe that this stock is still BTD as long as the 42s hold. If you want to play put ratios or put spreads or whatever, you'd probably want the termination of those to be down in the 224s. If it's closer to earnings, maybe down even into the 204s, 205s, that area has been a lot of support. I believe it would be again. The flash crash low, though, the problem was we did come down to those 195s. And if there is weakness, again, the algos cache these levels. You got to be really careful. That, to me, that risk is real. Just some quick stuff on the Silliness stocks. I've hated these stocks for a really long time. I've been talking about them being shorts and playing them that way. But you can see that this is starting to break down of a trend. We're getting close to a big 61.8 and also like the launch point of this big move down in the 48s. I do believe you can play some put ratios for short dated. You can see also this channel ends here, but I'm actually looking on another flush lower to reverse my ideas here just for a long for a bounce. Not that I like the story anymore, but I just believe that that area could set up for a bounce play. That's the Umbrella. Same thing in the GoPro. This is a stock. Oh my God, I've hated this forever. When they did the lockup, I think that CEO is a little worm. He unlocked the stock. He prematurely. The stock has done nothing but go down ever since. They trade at a very expensive multiple. They don't trade at a large amount times cash. But I mean, their sales. But I do believe that this stock could be a single-digit stock at some point. The reference all-time low is down here in the 28s. We had a bit of a reversal bar here. I put on a call spread, actually. I don't remember what the strikes were. I'm in that. It was starting to look a little good here, not so much Friday. If we do wind up coming down lower, I would probably play this with a put ratio, with like buying this all-time low as the strike and then something lower as the lower strike. I don't think this is going to be such an easy collapse the first time around, although we are consolidating here. That could be a pretty big flush if this breaks. Risk to me would be tremendous. I like I said, I only did this with a call spread. I am looking for like some type of a retest, maybe to a retest again of the breakdown area, the 37s. Although you can see we had that and now came back down, but it is possible we retest the backside of the old up channel on some type of maybe some short covering ahead of the quarter. Longer term, not really bullish. Shorter term, I'm kind of like a little SOH with a slight long bias, as crazy as that sounds, but that is the case. Other silliness, did have a downtrend break, got a 50% fib, trouble with the 50-day moving average. You really need to see that clear for a move up to the 43s. I like this with put ratios, with the termination put being down into 41s as this comes down into weakness. Near dated, same week or the next week maximum, because it could go much lower, much quicker. When you're in ratios, you're overwritten to the downside, meaning you're long a put up here and short 2 times down here. And if it knifes the lower strike, you can be in some trouble pretty quickly. I'll end on MBLY. This has been the weakest of the week. Look at this, cannot hold over the downtrend line. You had a bit of a reversal hammer here and then closed below it. This gets pretty bearish. Was a gap fill down here. It's held a couple of times. If you lose these hammers, this thing is going to collapse. I do believe that it is going to retest into these 35 area, 32, 35. I like that with put ratios for a move down. Hey, listen, if you break this high though, the 47, then I would be a little less dogmatic about it, and it would have taken out a big reversal bar and also been a confirmed trend line break, and then you could probably play for a little bit of a move up. I don't know how well that's going to play out, but I do like it for put ratios for lower. Anyhow, that's my story. I'm sticking to it. Be sure to follow me on Twitter. My handle is @JustinPulitzer. Be sure to hit the like button if you enjoyed this video. There's a little thumbs up below. Hit the subscribe link. You'll get notifications when I post new videos like these, or my Periscope rebroadcast videos, or even special edition videos. I've been a little lax on putting up some of the new ones of the special editions, but there are some that I am working on, and I think you guys are going to really like it. Anyhow, have a good rest of the weekend. Let's have a good end of quarter week, and cheers.